Welcome to the deep dive. Today we're tackling a real puzzle around a big name in India, Nippon Life India Asset Management, NAM India. Our mission here is to figure out this contradiction for you. Is this company really a structural decadal growth story you can't miss? Or is the current price tag, well, just too high for what might be a structurally impaired business?
Yeah, look, the starting point is pretty clear. Everyone agrees, analysts are unanimous, that the Indian asset management industry, that's a structural growth story, no question. You've got this massive multi-decade trend, the financialization of savings, people moving money from, gold or property into financial markets. That guarantees growth for the sector.
Okay, so the backdrop is strong. Let's unpack the bull case for NAM India itself.
Yeah.
What are those powerful drivers making it look like, well, maybe a lifetime investment?
It really boils down to two core things. First, just the sheer penetration gap. Think about it. Less than 5% of India's 1.4 billion people are in mutual funds. Compare that to the U.S., over 50%. The potential market, the TAM, is enormous, just massive runway there. And second, you've got this amazing SEPA culture, systematic investment plans. It shows real discipline from retail investors. These monthly contributions, they're hitting record highs month after month. We're talking something like 29,361 crore flowing in every single month as of September 2025. That's sticky money.
Okay, huge macro tailwinds. But how does NM India specifically capture this? They talk a lot about their moats, especially that distribution network, right? Their physical presence, particularly outside the big metros, in those beyond top 30 cities. That gets them what? Nearly 2.2 crore unique investors.
It does, and that reach is significant. Plus, you can't ignore the parentage moat. Having Nippon Life Insurance from Japan as a promoter, that gives them unique access. It opens up the Indo-Japan corridor, bringing in what you might call patient capital. It's less correlated, more stable. In a market like India, having that long-term funding, that's a real edge.
Okay, patient capital sounds good. But that physical distribution network, in today's world, with fintechs like Zerodha or Grow signing up millions online, isn't that old network becoming, well, expensive? A bit of a liability, maybe?
That's precisely the rub. That's the internal conflict you see in the research. NAM India is fantastic at gathering volume. It's a volume play, but it's really struggling to be a sustainable margin play. See, their profit engine, the active equity AUM, that makes good money around 55 basis points.
Okay, 55 BPs on active funds. For listeners, a basis point, or BPS, is just 1/100%, so decent fees there.
Right, but the volume driver, that's their huge share in passive ETFs index funds, and those earn very little, maybe 17 BPs. So here's the problem. Management's success in growing those low-yield ETFs is actually dragging down the average fee for the whole company.
So they're running up a down escalator, essentially. The more low-fee volume they get, the lower their overall blended yield goes. They're guiding for, what, a 2 to 3 BPs decline every year?
Exactly. Think about that. They need to grow their assets under management by maybe 18–20% just to keep revenue flat. That's tough. And this internal pressure, it's now crashing headlong into a huge external threat. That SEBI consultation paper from October 2025 on total expense ratio reforms, TERA reforms.
Let's quickly define T for everyone. That's the total expense ratio, the main fee investors pay, and it's how AMCs like NM India make their money. Why is SEBI, the regulator, messing with us now?
Well, SEBI's focus is consumer protection, driving down costs for investors, but the proposals, they could be devastating for AMC profits. They're talking about slashing the cap on brokerage fees paid by funds from 12 BPs down to just 2 BPs, and maybe a 15 BPs cut in the maximum base tier itself.
Wow. So what does that mean for the bottom line?
Analyst estimates, like from Jefferies, are projecting this could slice 30–33% off profit before tax, PBT, by FY27 or FY28. And the hit comes right where it hurts most, that profitable active equity business.
Ouch. So a regulatory hit to their high-margin business. And what about the low-margin ETF side? You mentioned volume there.
That's the other pincer move. Just as regulation hits the high-margin side, you've got new competition attacking the low-margin volume side. These new low-cost AMCs, often backed by discount brokers like Zerodha and Grow, they're targeting the commodity ETF space, starting price wars. That threatens even more pressure on those already thin ETF yields.
So squeezing margins from both ends, regulatory pressure on the profitable part, and new competition hitting the volume part.
Precisely. And this brings us right back to that valuation problem we started with. The stock's trading at a pretty hefty PE ratio, around 41.7 times earnings. That price seems to fully bake in the optimistic scenario, the 15-17% growth base case. But it feels like it's almost completely ignoring this very real bear case, maybe only 7-10% growth, if SEBI really cracks down hard.
Which creates for you, the investor, a really tricky situation. It looks like asymmetric risk. If things go well, the upside seems limited because it's already priced in. But if this regulatory bear case happens, that 30% profit cut, there could be significant downside, maybe 20-30% or more.
That's the core issue. So the final thought here is this. The Indian asset management industry, yes, undeniably a lifetime structural growth story. You want exposure there. But NEM India stock today, at this valuation with this regulatory cloud hanging over it, it looks like a do not buy. The real opportunity, that might only come after these SEBI rules are finalized, whatever they end up being. When the market fully understands and reprices the company for its new, potentially lower long-term profitability. Patience might be key here. Wait for the dust to settle.